Australia's biggest petrol retailer, Caltex, has been forced to reassure investors that it won't be following Shell and closing refineries. But as the country steadily loses its refining capacity, Caltex says an ill-conceived carbon tax may hasten the industry's demise. The warnings came at the company's annual general meeting as it revealed its weaker quarterly results. Philip Lasker was there.
As motorists across the country felt the increasing squeeze of rising fuel prices during the second half of last year, shareholders in Australia's biggest petrol retailer saw their shares go up.
2010 was a very successful year for Caltex and for its shareholders. The company achieved great things, including the continuation of the strong growth trajectory of the marketing business, record sales volumes for transport fuels, and the continued improvement of our refining reliability.
Although not all shareholders felt the rhetoric matched the reality.
Return on equity was less this year than it was in the previous year, and yet the chairman's made the statement that it was a very successful year, and from a financial point of view it doesn't seem that can be justified.
There was also some opposition to Caltex's executive pay arrangements for their determination that 3 years was long term. But the extreme weather and spiralling oil prices are starting to bite. Refiner margins were down quite a bit in the March quarter, knocking $24 million off the bottom line after tax. Quarterly profit almost halved to $77 million. In the short term, Caltex expects to sell more fuel and grow earnings, while the improvement in refining may take more time.
In refining, the medium to long-term outlook for supply and demand fundamentals are expected to improve, as we have previously outlined. However, we expect to experience short-term volatility due to the events in Libya and Japan.
With Shell closing its Clyde refinery in Sydney, there was plenty of talk about what that would mean for Caltex, which has 2 of Australia's 6 remaining refineries, Lytton in Queensland and Kurnell in New South Wales.
We're committed to our existing strategy, which includes refining as a key part of our integrated business.
But Caltex says that strategy could be threatened by a carbon tax.
I'm not telling you in one shape or another that we're about to close the refineries. We're very much committed to our refineries. We're committed to an integrated business model in which the refineries are very important. But it is a very challenging environment. We are price takers. We do not set the price in Australia. The price is set in Singapore. We have competitors in Asia that have refineries that are 5 and 10 times the size of our refineries, very efficient, very modern. This is who we compete against. As long as there is no carbon tax on those competitors, we cannot afford a carbon tax in this country on our refineries.
Caltex says with refineries disappearing, the government needs to take a close look at fuel security.